Hello dear audience, why closing entries are made? Closing entries are made to produce a zero balance in temporary accounts by transferring their balances to permanent accounts because company carries forward the balances of permanent accounts into the next accounting period. So generally we prepare closing entries to produce a zero balance in temporary accounts because company carries forward the balances of permanent accounts into the next accounting period. So what are the pre-requirements of making closing entries? To make closing entries, it is necessary to distinguish between temporary and permanent accounts. So if you want to close the temporary accounts, you need to know what are the temporary accounts and what are the permanent accounts. So what are the temporary accounts? Temporary accounts relate only to one accounting period. They include all income statement accounts and the owner's drawings account. So temporary accounts are those accounts which are shown in the income statement and owner's drawing account. So in summary we can see all revenues accounts, all expense accounts and owner's drawing accounts are the temporary account. By closing entries, we will close these three items. What are the permanent accounts? Permanent accounts relate to one or more future accounting periods. They consist of all balance sheet accounts including the owner's capital accounts. So the accounts which are shown in the balance sheet are the permanent accounts as well as the owner's capital account. So here we can see all asset accounts, all liability accounts, and owner's capital account are the permanent account. We will not close these three items because they are permanent. How closing entries are made? 4 entries are made for closing entries. Number 1 is debit each revenue account for its balance and credit income summary for total revenues. Number 2 is debit income summary for total expenses and credit each expenses account for its balances. 3. Debit income summary and credit owner's capital for the amount of net income. Number 4 is debit owner's capital for the balance in the owner's drawing account and credit owner's drawing for the same amount. So if we summarize how to prepare closing entries, the first one is we have to close revenues to income summary, and the second one is close expenses to income summary, and the third one is close income summary to owner's capital, and the last one close owner's drawing to owner's capital. Now we are going to see practically how to prepare closing entries. So here we can see an income statement. Generally we know that in an income statement there are accounts of income and expenses. Here we can see service revenue is an income with the amount of 10,600, and there are some expenses, salaries and wages expenses 5,200, supplies expenses 1,500, rent expenses 900, insurance expenses 50, interest expense 50, depreciation expense 40. Here the total expense is 7,740. So if we deduct this total expense from the service revenue, we will get the net income 2,860. So this is an income statement. From this income statement we can see there are some expenses and one service revenue. All are the temporary account. By preparing closing entries, we will close all this temporary account. So first of all, this income account, that means service revenue. To close this income, we need to put it in the debit side. Generally, we know that service revenue is credit, but here our purpose is to produce a zero balance. That is why this credit item will be debit to produce a zero balance. So service revenue is debit with the amount of 10,600, and we will close this income with income summary. Okay, so income summary will be credit 10,600. Now we will close this expenses. Generally we know that expenses are debit, but we will put these expenses in the credit side because we need to produce a zero balance. To produce a zero balance, we will put these expenses into credit side. So income summary will be debit with the total expense amount, and all the expenses will be in the credit side. Again I am repeating, purpose of closing entries is to produce a zero balance. So to produce a zero balance, we are placing them in the credit side. So income summary will be debit 7,740, and expenses will be credit with the specific or particular balances. Here we can see salaries and wages expense credit 5,200, supplies expenses credit 1,500, depreciation expense credit 40, insurance expense credit with the balance of 50, salaries and wages expense credit with the amount of 5,200, rent expense credit with the amount of 900, interest expense credit with the amount of 50. So by placing them in the credit side, generally they are debit, but we have put this expense in the credit side with the purpose of producing a zero balance. Okay, now we will close this net income. Here we can see the amount of net income is 2,860. We will close this net income with owner's capital account. So income summary will be debit 2,860, and owner's capital account will be credit 2,860. So with this third closing entries, we are closing the net income. Okay, so from the income statement we have prepared three closing entries. This is the first one, and this is the second one, and this is the third one. And we have to close another temporary account, and that is owner's drawings. Dear audience, generally we know that drawings is debit. So to produce a zero balance, it is debit, but to produce a zero balance, we will place it in the credit side. And to close this drawings account, we need to close it with the owner's capital account. So owner's capital will be debit with 500, and owner's drawing accounts will be credit with 500. Owner's capital is decreasing by owner's drawings. That is why owner's capital is debit, and we are producing a zero balance for the drawings account. That is why owner's drawing should be placed in the credit side. Thank you.